Kingston evening. So trust you're okay with that. And so before we begin the webinar in earnest, we're going to begin with a word of prayer, then I'll make a few remarks and won't keep you waiting, and the right over to the experts after that. So let's just bow our heads and let's read a word of prayer. Lord, even as we come to you this evening, we acknowledge that in you we live, move, and have our beings. And so, Lord, we thank you for just your providence in our lives, the lives of our families and our loved ones. Lord, we present the webinar to you this evening. We pray that the time will be mutually beneficial. And so, Lord, we just ask that you just continue to bless us abundantly. And Lord, we pray all these things in Jesus' name. Amen. And so I just going to bring some opening remarks and hand you over to Lauren. Now, what's interesting in terms of us meeting at a time like this, we're at an inflection point in the market, domestically and internationally. Some of the central banks have paused increasing their policy rates. Just today, the Bank of Jamaica met, and they have again decided to pause a policy rate at 7%. And so there's a lot of discussion taking place about what next, locally and internationally. And so this evening, we have two expert presenters who will tackle some of these issues. And of course, I'm sure they will ably point us in the right direction. And so what we're going to ask you to do as participants in this webinar, just to note your questions during the presentations. And at the end of each presentation, you get a chance to pose your questions either by place it in the chat, or you can use the raise hands feature. And after you have been acknowledged, then you get a chance to mic your question. And so I don't want to stand on ceremony. So without any further delay, I'm pleased to introduce our first presenter, who is Lauren Henderson. Lauren is a vice president. Let me bring up my script. At Stifel. She's based in Chicago. She is an economist for Stifel Financial. She focuses on research and analysis of economic trends and activity, world economies, financial markets, monetary and fiscal policies. So she has a pretty wide remit. She has been with Stifel for 6 years and works under the leadership of Stifel's chief economist, Dr. Lindsay Piesda, who is a friend to a lot of us here. Lauren is a member of the National Association for Business Economics. She holds 2 degrees from Loyola, tongue twister, University, Chicago, in marketing and economics. And she also earned her MBA with a focus in economics from La Jolla University, Chicago. She's based in Stifel's downtown Chicago office. And so that's a brief summary of the expert presenter who is before you. And so Laurel, without any further ado, I'll hand you over to do your thing.
Thank you so much. Are you able to see my screen here?
Yes.
Perfect. Well, it's certainly an exciting day to talk about the economy, with the Federal Reserve concluding its June FOMC meeting earlier this month and announcing its latest policy decision. But before we talk about the Fed and this month's decision, I'd like to present a general overview of the US economy, because at this point it seems that investors and market participants alike really have a number of questions, and they're really the same questions we had from last year, such as, is the US economy in a recession? Will it enter a recession? Has inflation peaked? If not, when will it peak? And what is the Fed going to do about it? But I want to start on a more positive note, because while most sectors of the economy are showing slower growth or waning momentum, the US labor market is not there, at least not quite yet. In fact, in the latest May employment report, we saw that the labor market added 339,000 jobs, well surpassing expectations and the strongest pace of job creation since January of this year. However, looking at the overall trend pace, you can see that job creation is trending lower this year at an average of 314,000 jobs versus about 340,000 jobs last year. We also see further improvement or strength when we look at the unemployment rate, now at 3.7% as of May. Now, this was a rise from the 3.4% rate reported in April, but broadly speaking, you can see that this is a marked improvement from the near 15% peak reached at the onset of the pandemic and still marks near a 5-decade low. However, one thing I want to caution, or one thing I'd like to talk about, when we look at the unemployment rates, I do think that this figure may be somewhat overstating the strength of the labor market. Yes, this headline decline has been impressive, reflecting the fact that millions of Americans have found gainful employment, but this decline also reflects the fact that many Americans have dropped out of the labor force entirely and are no longer looking for a job. Now, remember, you have to be actively seeking employment to be considered unemployed. So we always say it's very easy to get the unemployment rate down to 0 if everyone just simply stops looking for a job. But juxtaposed with a rise in the unemployment rate, we saw that the labor force participation rate remained steady at 62.6% for the 3rd consecutive month. And this was a 3-year high. However, at 62.6%, this is still much lower than the pre-pandemic rate of 63.3%, representing a potential gap of around 3 million workers. And broadly speaking, looking at this chart here, you can see that the participation rate remains subdued. And really, this is far from an ideal scenario, particularly as businesses remain desperate for workers. So as businesses remain desperate for workers and continue to search for workers, they are, number one, resorting to extending work weeks of existing employees. So current employees are working longer hours. And number two, raising compensation as an incentive to keep current employees on board and to entice new employees to fill open positions. So as expected, wage pressures remain elevated, really as they have for the better part of the past year. And looking at the data, we saw that average hourly earnings rose 0.3 percentage point in May and 4.3% over the past 12 months. This was down slightly from the 4.4% annual gain in April. But going forward, some businesses, particularly smaller businesses, will find it harder or more difficult to absorb these higher labor costs, higher wages, and they may be forced to downshift investment, production, or maybe even close their doors altogether. Now, on the other hand, larger businesses, those with more access to capital, these businesses may be better able to absorb these higher labor costs, but we would expect them to replace labor with technology wherever they can. And really, we saw this trend start before the pandemic, but I'd say that the pandemic really exacerbated this trend. Because I don't know about you, but if you've been to an airport or a grocery store lately, it seems like the self-checkout option has grown exponentially. And I think this is a good example of businesses using their dollars more towards technology and less towards human labor. And furthermore, this has really been a supply side story, meaning it's not the lack of available jobs, but it's the lack of available bodies willing to come back to work and fill these open positions. And looking here at this chart, this is the JOLT survey, which stands for the Job Openings and Labor Turnover Survey. And looking here, you can see that there were over 10 million job openings as of the latest report, suggesting producers remain desperate for workers, but there just simply aren't enough workers. However, I do think it's important to note that these job vacancies or job openings are down from a near-term peak of around 12 million. Additionally, looking at the savings rate here, we see that the savings rate was quite elevated for some time, resulting in roughly 6 trillion in accumulated wealth. But of course, as of late, as consumers have drawn down that stockpile of savings, we see that the savings rate has declined to 4.1% in the latest report, especially as some of the fiscal support has faded. And at the same time, consumers are turning to credit cards and other sources of debt to perpetuate their spending habits as this government fiscal support fades and as that stockpile of savings dwindles. And looking here, you can see that credit card debt alone rose 17.2% in the first quarter from the year prior. And this marked the largest annual gain since 2001. However, it is important to note that most households are better equipped to take on at least some additional debt burden, and debt as a percent of disposable income is still near the lowest on record. For some, though, I'd say that the notion of a reduced or evaporated wealth cushion, this is causing an outright shift or reduction in spending habits. Now, this might mean spending less overall and curtailing purchases entirely, but for others, this might mean downgrading the quality or brand of their purchase. So instead of buying the name brand shampoo or cereal, consumers are turning to generic brands. And for others, particularly in the younger generation, this has resulted in what we call a binge spending scenario, whereby consumers will pull back as much as possible in one month in order to purchase a larger ticket item the next. So maybe those Taylor Swift tickets that brought down Ticketmaster here in the US. But really, regardless of the form it's having, it's clear that consumers are shifting the goods and services in their basket on a monthly basis, something we as consumers do when we're increasingly concerned about our future financial footing. And in looking at the data here, you can see that retail sales rose 0.3 percentage point in May, following 0.4 percentage gain in April, with a monthly average of just 0.1 percentage point. And year over year, sales rose 1.6% in May, up from a 1.2% gain in April. But at this point, with spending still positive on average, this is continuing to put pressure on producers to ramp up production to meet the heightened level of demand. However, if producers can find the workers they need, which really still remains a big if, producers are still having some difficulty obtaining the parts and materials they need for production, with supply chains still trying to get back to full capacity in the aftermath of the pandemic. And so this is leading to extended wait times and inventory complications, and in some cases, higher prices. And looking here, the dark blue line, this signifies the US ISM Manufacturing Index. And I should note that this is a diffusion index. So a reading above 50 simply indicates expansion, while a reading below 50 signals contraction. Looking here, you can see that US manufacturing activity has really been under pressure as of late, falling into contractionary territory as of November of last year. Now, conversely, the light blue line, this indicates Chinese manufacturing activity. And you can see that Chinese manufacturing activity has really been bouncing along that break-even line since June of 2021. And really, this indicates that this wasn't the flip of the switch scenario that many were hoping for when China eased back its COVID restrictions. But switching gears here, touching on fiscal policy, we saw that increased uncertainty, heightened level of disconnect in the labor market, heightened level of inflation. This was an opportunity for officials in Washington to continue to ramp up spending in the name of economic growth, job creation, and taming inflation. And this is exactly what we saw and what we've been seeing. Now, the Trump and Biden administrations combined spent around $6 trillion to combat the pandemic. However, looking here at this chart, you can see that the US was not alone, and developed nations in total spent around $17 trillion. but you can see that the US spent almost double the next highest spender, with that being Japan. And really, regardless about how we feel about COVID policies and whether or not they were warranted, we have to have a realistic conversation about the effects of some of these policies, with one being a massive run-up in debt. Now, in fiscal year 2022, that was the latest data available, total public debt outstanding rose to 31 trillion, and this was an all-time high. And according to the CBO, which stands for the Congressional Budget Office, total public debt is expected to reach over 46 trillion by the end of the next decade. Additionally, another effect of fiscal spending during the pandemic was a jump in inflation. And now, while most countries are contending with higher inflation rates relative to the pre-pandemic world, US inflation rose much more quickly and rapidly than most other countries, largely due to the influx of stimulus early on, with much of the stimulus in the form of direct payments to households and individuals. So with all of this, what does this mean for the Federal Reserve? What does this mean for monetary policy and for future Fed meetings going forward? Well, I'd say it's certainly been an eventful year so far in terms of monetary policy. At the Fed's first FOMC meeting of the year in February, the committee opted to raise rates just 25 basis points after reducing the size of rate hikes from 75 basis points to 50 basis points in December. So the committee then raised rates another 25 basis points at its March meeting and another 25 basis points at the May meeting. So totaling 10 hikes in about 14 months, the committee has now increased the upper bound of the federal funds target range to 5.25%, the highest since 2007. However, at the latest June meeting, as expected, the committee opted to hold rates steady at 5.25% and assess the earlier impacts of policy firming on the US economy. And looking at the most recent June statement, the committee continues to characterize growth as modest and job creation as robust. The committee did, however, acknowledge the recent volatility in the banking sector, but was very clear that the banking system remains sound and resilient. The major change in the June statement, however, was that the committee made a slight but important tweak to the language, noting the extent of additional policy firming that may be appropriate versus the extent to which may be appropriate. So in other words, the committee is leaving the door open to additional rate hikes and in some ways actually indicating that they will likely be coming soon. So acknowledging the recent volatility in the banking sector, the latest report on bank lending standards noted that 46% of large and medium banks reported tighter standards, with 47% of smaller banks reporting tighter standards in Q2. And this was up from 45% and 44% respectively in the first quarter. So with the Fed indicating that the banking sector remains strong and noting modest growth and robust job gains, how much higher will rates need to rise? Well, looking here, this is looking at the latest summary of economic projections, specifically looking at the dot plot. We saw that the majority of officials expect the terminal rate to be 5.3%, and this was up from 5.1% in March, with 3 officials actually forecasting a federal funds rate of 5.7 to 6.25%. So with 4 meetings left this year and the committee forecasting a higher terminal rate, this really justifies a sort of skip re-engage pattern that we're likely to see throughout the rest of the year, with the Fed holding rates steady and then raising rates at the following meeting. However, looking at the market's projections, the market continues to price in a rate cut at the start of the year, with the terminal rate reaching 5.4%, And this is much lower than the Fed projection of 5.6% for this year. However, if the data continues to run strong with a tight labor market, arguably becoming tighter, and still elevated inflation, the Fed will have a difficult time justifying holding rates steady at future meetings, let alone a first-round reduction in rates anytime soon. After all, restoring price stability should remain the Fed's primary focus. And we're not that convinced that the Fed will be able to cut rates by the end of the year or at the start of next year, especially when we look at certain components of inflation. We see that some are proving more sticky in nature. For example, looking at this chart here, looking at the dark blue line, that's shelter costs, and shelter costs have just peaked, with core services, excluding shelter, a reading of inflation that Federal Reserve Chairman Jerome Powell continues to be concerned about, at only retreating minimally to 4.5% as of the latest report. So remember, the Fed has a 2% inflation target. And while it's great that inflation has slowed from peak levels, 4.5% is still well above that 2% target, really justifying a higher for longer scenario that may be needed in terms of the future rate pathway. So with all of this, what does this mean from a growth standpoint? Well, we saw in the latest GDP report released this morning that GDP was revised up to a 2% gain in the final first quarter, following a 2.6% gain in the fourth quarter. But the general thesis of activity across the first 3 months of the year continues to be one of resilience, with the consumer really leading the charge despite businesses pulling back, and maybe some instances more than necessary, in anticipation of further weakness ahead. However, going forward, as the Fed continues to raise rates as we expect them to do and tap down growth and investments in consumption, we're likely to see that growth take a hit. However, given the resilience of the consumer, as I mentioned earlier, we're likely to see this downturn in growth occur sometime in Q4 or beyond and be relatively short and shallow in nature. Additionally, what's complicating the equation for the Fed in terms of inflation and in growth, as if the equation wasn't already complicated enough, is the source of inflationary pressures, with much of them still stemming from the supply side of the equation. So in other words, the Fed has been crystal clear it's going to do whatever is necessary to bring inflation down. However, raising rates won't end the war in Ukraine or fully alleviate supply chain issues that we're still experiencing in the aftermath of the pandemic. So following through with such an aggressive rate pathway will almost assuredly result in a downturn to growth. And wrapping up here, as I'd like to leave plenty of time for questions. So rate cuts are not yet in our forecast, unlike the market's projections, as inflation remains higher than officials would like to see. The Fed is likely to move forward with a sort of skip re-engage pattern, but consecutive rate hikes are not off the table, as we heard from Chair Powell himself this week at the ECB forum. And to quote Powell, although policy is restrictive, it's not restrictive enough. So in other words, the Fed still has more work to do to bring inflation down. Additionally, there's still a number of wild cards and risks to the outlook that could potentially bring inflation higher, including the ongoing war overseas. Also, as we head into the summer travel, or we're already in the summer travel season and hurricane season, we could see a rise in crude prices, adding additional upward momentum to inflation. Not to mention the consequences of the recently averted debt ceiling crisis here in the US, with one being still a potential downgrade to the nation's credit rating, an upcoming presidential election in the US, which only adds uncertainty in terms of the outlook. So with that, I'd like to thank you and open it up for any questions you may have.
Thank you for your presentation, Lauren. You certainly had us in rapt attention. I was on the edge of my seat. I almost fell off twice. Wow, but Chicago's finest. So I'm going to open it up for questions. You can either place your questions in the chat, or you can just indicate using raise hand feature, and then you'll be acknowledged. I want to ask a question while person put your thoughts together, and it's the old thing about fighting the Fed. The projections from Stifel, which you just presented, they're quite clear cut in terms of the expectation that the Fed isn't done as yet. So why is there this disconnect in the market, with other participants thinking that pretty much the Fed is done and the next move is done? Just want to speak to that first, Lauren.
Yeah, I think that's a really good question. And I think, unfortunately, time and time again, the market is reminded to not fight the Fed. And us, along with the Fed, continue to project more rate increases, especially because inflation is actually proving more persistent in nature and not less. So I think that the market is really looking at that peak inflation rate and saying mission accomplished. It's come down. It's going to continue to come down. But as I mentioned, when we look at certain components of inflation, especially core inflation, which the Fed looks at, it monitors much more closely as it strips out volatile food and energy prices, we see that, yes, it's come down, but it's not coming down quite as fast as officials would like to see. So I think that really just justifies this higher for longer scenario. And I think that eventually the market will have to get on board. And once the data comes in, we have an important PCE report tomorrow morning. So I think that will also be another data point the market is watching, and we'll see if the projections change after that report as well.
Okay, thank you for that. There's a question from Monique French, and the question is, do you think it's possible the Fed is misreading the resilience of the US economy because of the lag effects, which you mentioned earlier, and also just the unusual situations, COVID, the war, the supply chain issues? And so I'm just quickly paraphrasing. So look, whether they are misreading. Let me read again. Do you think it's possible the Fed is misreading the resilience of the US economy because of lag effects and also the unusual nature of some of what is pretty much driving inflation?
Yeah, another good question. I think that we know there's been a lot of talk about the lagged effects, and even Chair Powell was asked this earlier this week at the ECB forum, and there is a lag, and I think that's why the committee opted to hold rates steady at the latest June meeting. But we do know that the lag this cycle or this time around is much less than previous cycles, because we have a lot more information coming from the Fed and Fed officials themselves, such as press conference after every meeting. We have updated projections quarterly, and we have Fed officials themselves speaking publicly in many different forums and venues almost daily. So I think the market is very much aware of where Fed policy is going to go at the upcoming meetings, given that the Fed is being so vocal and open with their views on where they see policy going. So I think that the lag effect is something to consider, but this time around, it's much less than in previous cycles.
Okay, thank you for that. And Monique is getting warm. She has another question. This one is very pointed. It says, do you think the US Fed should continue to hike beyond, say, at most another 25 basis points?
Yeah, we are forecasting right now terminal federal funds rate of 5.75%. So that would be at least two more rate hikes from here. So we do think that the Fed should just continue to hike rates while they can, as they're continuing on this process, because it would be more difficult for the Fed to pause for a prolonged period of time and then have to initiate rate hikes again, as the terminal level may have to be higher than had they just continued along hiking rates to fight inflation. So yeah, we do think the Fed should hike more than 25 basis points by the end of this year.
Okay, no, that doesn't give money comfort or money. I say the truth and nothing but the truth. Thanks a lot for Lauren. I just want to ask another question while we wait for the participants to share the question. In terms of what you presented to us, what does that portend for the equities market, U.S. equities market, or just generally, global equities market?
Well, it seems that the equity market has rebounded this year, and I think a lot of it was driven by certain sectors. I think technology has, especially in the AI component, has been a large driver of that. So in terms of the overall equity market, we don't have a specific forecast of where that is set to go. We can reach out to our chief equity strategist, but overall, it seems like the market is looking at the economic data, but certain sectors are driving the growth, such as technology. So with technology continuing to be strong contributor, then we'll see positive equity returns in the near term.
Okay, thank you for that. Not seeing any other questions in the chat. I'm not sure if there's anybody who wants to, voice their question to give you an opportunity now. So I'm going to take that silence as a yes, that there are no other questions. So Lauren, your presentation was, for me, it was crystal clear, as I said, Chicago's finest. May I, a trick question, how do you pronounce the name of your university?
It's a hard one. It's called Loyola. So it's kind of a tongue twister there, but Loyola is the name. So, okay. But I thought you did a great job with the pronunciation.
If it's society, deep pockets will offer a prize at the end for someone who pronounced it. Well, okay, all right, thanks for that. Just one last question for Monique, and it says, do you see any major fallouts in any key industries, commercial real estate, for example, if the Fed does hike to the level that you're projecting?
I think at this point, we don't see the commercial real estate sector in general is something that we're monitoring, and we know that the Fed is as well. In the stress test released yesterday, that was a component that they added, that was included when they were conducting the stress test. So in terms of specific sectors, at this point, we don't see any one sector, let's say, fall off a cliff from the Fed continuing to hike rates. However, there'll be pressure on many sectors of the economy as the Fed continues to hike, as we expect them to do, especially on that commercial real estate sector. Along with, and to touch on the commercial real estate sector, this work from home or work from anywhere environment, that is really also putting pressure on it as people choose to not go back to an office. So certainly something that we're monitoring, but at this point, we don't see any major fallout industry-wide.
Okay, thank you for that. So with that, we're going to give Lauren a chance just to catch her breath. So Lauren, we certainly thank you for your presentation. It was of the highest standard. It's obvious that you're at the top of your game. And, I just want to say that that was clear. And we certainly thank the participants for the questions. And if it's possible, we're going to ask you to stick around for the rest of the webinar, just to hear some of the other presentation and discourse, okay? So once again, we certainly thank you, and God bless.
Thank you so much.
So, you're welcome. Okay, so while we have been digested what Lauren, you have presented, before we move to the presenter, we're just going to launch a poll. It's a single poll. We're going to ask for full participation just so we can get a sense of, you know, the profile of our audience. So I'm going to ask everyone to participate, and then we transition to the second and final presentation. Just give you a minute. We're going to allow another minute. There are some persons who are pondering their response. So I don't want you to feel rushed. Okay, so I think in the interest of time, we'll close the poll there. Thanks a lot for your response. And so without any further delay, you know, so we took it international. So now we're gonna go local and regional. And so our next presenter, Jermaine Burrell. Jermaine is, let me move this out of the way. Jermaine is the head of group research at JMMB. He has a BSc in economics and statistics and an MSc. One sec, my screen is dancing around. Please forgive me. I'm not sure what's happening. Hopefully somebody has wrestled the controls for me. So he has he has a BSc in economics and statistics and an MSc in economics. One sec. My screen is dancing around. Not sure what's happening. Okay. And an MSc in economics, specializing in international finance and game theory, both from University of the West Indies, Mona. Jermaine has an excess of 19 years experience in the Jamaican financial services sector, and he has held various positions. So he has a pretty diverse background. He's been senior economist. He has been investment and sovereign research analyst, as well as senior equity analyst. Jermaine's areas of expertise and exposure stretch from investment assets, you know, such as sovereign bonds, corporate debt, and stocks, all the way to the, you know, the more complex stuff, the structured assets in developed markets, mainly in the US and UK, as well as developing markets, including LATAM and the Caribbean region. Jermaine also has training in sovereign research methodology from Standard & Poor's. In just concluding the intro for Jermaine, I'll just say that he has had regional exposure to investment, corporate and retail banking, asset trading, the pension industry, insurance brokerage, to name a few, in Jamaica, Trinidad, Dominic, and Barbados. It might surprise you that Jermaine is a qualified attorney law, and he was called to the bar in February 2017. Jermaine also has training in business strategy from University of Cornell, where he has learned how to utilize microeconomic theory to analyze business positioning. So while I catch my breath, without any further delay, I give you Jermaine Burrell. Jermaine, over to you.
All right, good night or good evening, everyone. Hope that you're seeing me properly. Thank you for having me, Mr. Miller. Let me just go right ahead and share my screen. All right. All right, I hope that everybody is seeing the screen properly.
Yes, nice and clear.
All right. All right, as I said, good night, everyone, and thank you again for having me. So I'll be giving the Jamaican economic outlook. Let me just adjust this little part of the screen here so I can see everything properly. All right, here we go. All right, so basically what I'll be doing is that I'll be taking a look at the international space and then kind of drilling down into Jamaica and trying to keep everything as concise and as tight as possible. All right, so I'll start off with the global outlook. We got a very nice global outlook from our first presenter. So I'll just be looking at it from the perspective of, sort of local perspective. So the characteristics of the current economic paradigm. Ongoing COVID pandemic, yes, it's probably waning now. So it's most countries are actually no longer undertaking policies, but we are on the back of a COVID pandemic. The Russia-Ukraine war has led to a period of global uncertainty. We continue to see a world characterized by global risk aversion. We still have relatively high prices, though declining. Sanctions levied by the US and Western Europe on Russia, and countermeasures employed by Russia, primarily using oil and hydrocarbons to offset the sanctions of the West. Now, what this has meant is a period of still stubbornly high inflation globally, increased interest rates by central banks in an attempt to slow credit growth and liquidity, reduce borrowing or lending, and also, that would lead to a sort of contraction in economic activity. Now, the graph overleaf, it kind of shows us how inflation has changed for Jamaica and some of its major trading partners and major tourism source markets. Now, when we look at it, we see where in 2017, we see inflation at relatively manageable levels for China, Canada, Jamaica, Japan, the UK, and the United States. But we realize that by the time we get to 2022, and we would have seen a spike in inflation for almost all of those economies identified. The graph to your right really gives us a graphical representation of how inflation would have changed over that time period, where we see that spike by the time we get to 2002. Importantly, we see where 2023 and 2024 suggest that inflation levels should come down, which is very important from our perspective. Now, as inflation climbed, policymakers globally would have responded with a raft of measures. These include increasing interest rates, as we spoke to before, increasing the cash reserve requirement for commercial banks and other policy actions, such as a halt on the approval of the issuance of USD-denominated debt instruments. We saw that sort of announcement locally. Now, central banks are cognizant of the fact that their policies really can't directly affect international commodity prices like that, right? However, the removal of liquidity from the market, it helps to reduce the upward pull on prices via what we call in economics demand pull inflation, and it takes out a certain amount of liquidity or increased cash from the system, takes that money from the hands of consumers, and therefore reduces that additional pull that you would see on commodity prices. Increasing interest rates also slows economic activity as well as reduces credit growth. Now, again, over here we show how global central bank policy rates would have changed over the last couple of years as well. Again, for most of the sovereigns, US, Canada, the major trading partners for Jamaica, the European Union, etc. 2016 and 2017, very, very low interest rates, are relatively low. But by the time we got to 2022, we saw a significant uptick. As at 2023, we see where rates are now. We see where Jamaica's rates are, and we know that the central bank has halted its rate hiking cycle, at least for the time being. Again, the forecast is for rates to begin to come back down by at least 2024. So what we have is that we did, we looked at the Bloomberg survey of economists, and this would give us a view of what the private sector is really seeing in the United States. So I look at the Bloomberg data suggests that most of the economies have seen policy rates that are the highest that they have been. Based on where rates are now as at June 26, 2023, the consensus is suggesting that rates for the major economies identified here and the major trading partners for Jamaica should go up by approximately 50 basis points on average by the end of 2023. And for the US, even though the Fed has recently paused, the market still expects rates to increase by about 35 basis points by the end of 2023, based on this latest survey from Bloomberg. Now, US Fed policy. So from a policy perspective, right, the actions by the federal authorities tend to have a significant impact on Jamaica's economy. This is so given that US policy rates tend to represent the global benchmark for risk. But for Jamaica in particular, we are very intricately tied to the United States. So most of our external debt is denominated in US dollars. Most of our global bonds, our sovereign debt, etc., is in USD. The US is our largest export market, representing 46% of our exports. It's our largest import market as well, representing 35% of imports. It's our largest source market for tourism. Approximately 70% of our visitors are from the United States. And if we do like a rough calculation to look at the expenditure, that turns out for US visitors to be roughly about 2.94 billion. The other very important part of the tying in with the United States is the fact that US 3.4 billion in remittance inflows comes into Jamaica. Approximately 60% of that, which is about 2 billion, is directly from the US. And these are based on 2021 and 2023 estimates respectively from the JTB and the BOJ. So clearly, whatever happens in the US has a significant impact on us here in Jamaica. What I try to do from an economics perspective is that I tend to follow unemployment among African Americans to get a fairly decent idea of what might be a barometer in terms of unemployment for some Jamaican families. Now, in terms of the outlook for the US, I don't need to go deeply because our first presenter would have done an excellent job. But just to note that the numbers that you see in blue with little asterisks beside it, that would represent official forecasts from the US authorities, while the red would represent, again, the survey of economists from Bloomberg. So clearly we see where for 2023 and 2024, we see growth of about 1% for the US economy. When we look at the housing market, we still see, even though things are kind of pulling off a little bit, we still see where there's expected to be a recovery by about 2025. In terms of unemployment, unemployment still projected to be relatively low, as our first presenter had said. And in terms of interest rates, as we said before, rates projected to climb for 2023, but then the expectation is that by the end of 2024 at least, rates should be coming down from a policy perspective, which is something that us in Jamaica that we're looking forward to. Now, the 12-month inflation rate, again, the CPI index, inflation had peaked earlier in 2022 at 9.1%. We see where things have come down for the United States to about 4.5% now, 4% here. And it's suggesting that rates are coming down close to where the Fed's target rate is, which is about 2%. So that is good from a Jamaica perspective because we want things to sort of normalize so that domestic interest rates can also come back down. Now, US inflation, as we said, continues to decline. The general outlook, which is really from the private sector sort of perspective or from market participants, is that by about Q1 or Q2 of 2024, inflation could fall below 3%. It is important for us to note that 3% may not be enough for the Fed to start reducing rates, but the market is relatively optimistic that once rates begin to fall below 3%, then the Fed should respond in terms of cutting rates. I would believe that the Fed will wait until rates would have settled at 2% or approximately 2% before they begin to cut. Another factor that I find to be important is what's going to happen in terms of economic growth, right? Will there be a recession? That is something that a few individuals have been looking at, whether or not there's going to be a hard or a soft landing in terms of whether or not the US economy will have a significant or aggressive contraction in growth, or whether or not the reduction in growth will not be as aggressive. Those are factors that we believe that the Fed will take into account, and that this will impact how or when they decide to cut rates, or whether they decide to leave rates where they are. Now, again, this is just a more deeper dive into what the market is thinking about. US inflation continues to decline. So I believe the view from the market is that optimistically by about maybe Q1, Q2, based on the Bloomberg weighted average, as well as I look at the median forecast, it's suggesting that optimistically rates could come down by about Q1 or Q2 of 2024. Remember that this is the market view, right? So it may be different from the official view as noted by our first presenter, but the market seems to be a bit optimistic. It waits on every data that comes out and then it responds. So the sentiment that is being expressed now might not necessarily be the same if the data changes a few weeks or a few months down the road. Now, some market participants have actually been suggesting that there's a 64% probability of a US recession. And this is based primarily on historical factors, right? As a recession normally follows when we have an inverted yield curve. So what I have here is the US government yield curve, which shows the inversion, and the fact that, this historically is something that there tends to be a recession after there's an inversion of the yield curve. It's not a must, but we will have to, take note of it because the possibility does exist. And remember that for Jamaica, a US recession would lead to concerns now for tourism, in terms of discretionary spending, whether or not persons will decide to go on that vacation. Also for remittances, remember that remittances is a very big thing for our economy, in that it comes directly to households. It represents spending. When we look at some work done by Professor Curtin at UWI, it suggests that remittance inflows go directly to necessities for many households in Jamaica, such as paying rent or mortgage, sending the children to school, etc. So if there is a fall off in terms of the US economy, while we note that most persons from Jamaica who are employed in the US tend to be in certain sectors that tend to be relatively recession proof, it is still something that we have to take into account. All right, we go now to the Jamaica outlook. All right, what will frame the outlook for Jamaica? And I wanted to make sure that I got a number of these points across, or what will drive our view. So the recovery from COVID-19, sorry, the relaxation or elimination of restrictions on movement, the return of investors, tourism recovery, pent-up demand for travel, and also the ability to do remote work. Remember also that for the local economy, the resumption of alumina production from the Jamalco plant, which was actually closed during the January to March quarter of 2022. Bauxite mining and alumina contributes about 5% to total GDP growth. So once there is the closure of any refinery, it does negatively impact the numbers. And what we're seeing is a resumption of production. So that should be a positive. We expect domestic inflation to ease. We expect it to come within the target, the BOJ's target of about 4 to 6%. The 12-month inflation rate is at 6.1% as at May 2023. However, it's important to note that any reduction in terms of interest rates will be predicated on what happens in terms of the Fed, the United States Fed. Remember that locally, there are still concerns regarding the spread between US and J dollar rates, concerns about capital movement, right? That is the movement from one currency to the other. These are still concerns that the central bank will bear in mind, as well as the government. Note also that any rate action by the BOJ, there's normally a time lag. So they will more than likely wait until the Fed acts, and then after the Fed acts, they probably will respond in terms of any domestic interest rate movement. That's our opinion. We expect domestic interest rates to remain elevated as well, definitely for the rest of this year. Now, I wanted to highlight this graph to show how massive the effect of COVID-19 was in terms of our tourism numbers, right? If you look at our graph more to my left, you will see that the impact of 9/11, there was a fall off, but it wasn't as pronounced. When you think about what would have happened in terms of the 2008-09 Lehman-driven financial crisis, you see a little bend in the graph in the middle there. But if you look at the impact of COVID-19, it's almost as if the entire thing fell off a cliff. And if we remember from COVID-19, we'll recall that there was a time when there were no cruise passengers. So this graph is actually 12-month visitor arrivals for both stopover and cruise passengers. So it really shows how significant the impact of COVID-19 was on the tourism market. It really got a massive hit. And therefore, this will also highlight to you the sort of recovery that we're seeing in terms of tourism numbers now and the strength of that recovery, and therefore the positive impact that it will have in terms of boosting our economic numbers. Now, as I said, still relatively high domestic interest rates. And once we have relatively high domestic interest rates, we know that it will impact the cost of capital. It will definitely have an impact on the capital market financing. Individuals and institutions, and companies that are looking to roll over debt. They're looking to roll over debt now at higher interest costs. Those that were looking to raise new debt may decide to not enter the market based on how high rates have been climbing. There is also a negative impact on construction. And why I highlight construction is that a number of financial institutions, in terms of their bank loan portfolios, a number of them would have actually had significant exposure to construction because of the boom that was happening. So with higher interest rates or higher lending rates to developers, this is going to be an issue. What will also frame our view, domestic equity market, we expect it to be negatively affected as liquidity flows into fixed income. The international bond market as well, we continue to see relatively high yields or low prices. Hence, when we look at the balance sheets of most financial institutions, it's really made up of two primary things. It's loans on one side, and on the other side, you have interest income and GOJ and EM bonds, right? Now, remember that once you have higher domestic interest rates, you have higher mortgage rates, higher interest rates in terms of car loans, credit card rates. And remember also that in terms of the capital adequacy ratios, the CAR for most financial institutions, remember that once you have a fall off in EM bond prices, right? When you calculate your CAR, there's normally that negative impact in terms of your adequacy ratios. So that helps to frame our view. On the positive side though, the GOJ is expected to target a fiscal surplus of about 0.3% of GDP for fiscal year 2023-2024. Capital expenditure to come in at about 2.5% of GDP, and that's about 75.3 billion. The debt to GDP ratio is expected to decline to 74.2% by the end of the fiscal year. And in my view, right, and in the opinion of members of my team, the possibility of a rating upgrade by S&P from B+ to BB- is definitely on the cards, given where the fiscal numbers look now. Obviously, the international environment is a challenge, but we believe that Jamaica's numbers are headed in the right direction, and this is this helps to frame our view of the outlook for the economy for this year. Don't want to spend too long, but then we have, from a domestic perspective, record low unemployment at 6%, driven by the BPO sector. The record low unemployment and the BPO sector is expected to drive certain aspects of tax revenues, in particular GCT, transportation as well, transport, storage, and communication. We expect to get a bump up. In terms of the exchange rate, we expect a marginal fluctuation in terms of, marginal appreciation to depreciation, but generally stability. Most of the movement, we expect it might occur close to the end of the quarter for particular reasons, as noted by certain financial sector entities and the positioning that they normally tend to take. The NIR is at record levels, 4.2 billion, which represents 36 weeks of goods imports and 26 weeks of goods and services imports. And the record level of the NIR is there to support any kind of BOJ intervention in the market. Remember also that we would have received 968 million from the IMF as a part of their precautionary and liquidity line. We also have at our disposal 764 million under the Resilience and Stability Facility for Jamaica. So not that the government has drawn down on any of this as yet, but this additional funding is there should there be any balance of payments issues. The financial sector, from a technical perspective, some financial entities are short USD, but they are long on US dollar liabilities. This is more on the technical side of the market. So because they are short USD with USD liabilities, you might find that at the end of the reporting period, right, they may have to come back into the market to sort of buy US dollars in order to cover the USD liabilities. In terms of margin, remember, many financial institutions take margin to purchase GOJ debt and also other EM bonds. If there is a significant movement in terms of the bond prices, then you might be asked to find more margin in order to cover your position. So this is also something that would help in terms of giving us a view of where we would expect the exchange rate, where we would expect the FX rate to come out. Risk to the forecast, as my previous presenter spoke to, the Atlantic hurricane season. Remember that for Jamaica, we are in a hurricane belt. So this really leads, normally what we would see when we have a hurricane issue, if one does come, is that there's damage to the infrastructure. The government would spend, and in spending, the deficit normally is, a little bit wider than it would normally be, or if there was a marginal surplus, the surplus would be eliminated and you come out at a sort of balanced budget. But what it would mean is that a slowdown or a reduction in the pace of the decline of the debt to GDP ratio. So therefore, this now could probably lead to a reduction in the likelihood of a rating upgrade. On the positive side, however, remember that we have catastrophe insurance here in Jamaica. We have a 185 million facility with the IDB and World Bank. I think it's supposed to expire by the end of this year, December 2023. Hurricane, there's a risk to the local inflation forecast as well. Remember that 35% of our inflation basket is food. If inflation climbs temporarily out of the BOJ's target range, this would lead to a further delay in terms of the cutting of interest rates, even though we believe that it is the Fed that is the main factor for us domestically. The resilience or strength of the US economy, as spoken to by our first presenter, still low unemployment numbers. There may be the legacy effect of the US fiscal stimulus. This could lead to stubborn inflation, or inflation taking longer to come within the Fed's target. This would therefore lead to a delay in terms of the reduction of US interest rates, and then that would also by extension lead to a delay or an extension of higher interest rates in Jamaica. Again, we don't know in terms of the escalation of the Russia-Ukraine conflict. That's a potential risk as well. Remember that there is currently the allowance for the exports of grain from the Ukraine based on the Russia-African relationship. If let's say that there is a change in that view and Russia gets overly more aggressive, then and they decide that, listen, they're going to not allow Ukraine to export anymore for whatever reason, that will have a negative impact in terms of global inflation. Again, maybe stubborn US inflation, and then again, a delay in terms of the Fed cutting interest rates. And there are a myriad of other risks, but these are the ones that we consider to be very important. Oil prices as well is another factor. We know that OPEC sometimes looks at cutting production in order to maintain higher prices. This also has a pass-through effect onto inflation. So that's another risk to the forecast. Now, for the Jamaican economy, GDP growth. So we would have seen where growth came in at about 5% for calendar year 2022. Some of the key areas that we saw in terms of recovery, tourism did particularly well, transport, storage and communication, the wholesale and retail trade. Many of these sectors of the economy would benefit from a return to normality and an elimination of the restriction in terms of movement. In terms of for fiscal year 2022, 23, the economy grew by 4.3%. Most of the major sectors that we identified before would represent the boost for those numbers. The local economy up to the quarter here, the January to March quarter 2023, the economy continued to expand. It came in at 2.7%. So we are still seeing a certain amount of growth in the Jamaican economy. A lot of it, however, is recovery from the COVID-19 and its effect. In terms of the outlook, the PIOJ has real GDP projected to grow within the range of about 1 to 3% for fiscal year 2023-2024. In terms of the IMF's forecast for calendar year 2023, they are seeing possible growth of 2%. S&P is forecasting calendar year growth for 2023 at 2.5%. Us here at JMMB, we're more seeing something within the region of 2 to 2.5%. What we want to highlight, however, is that over the last 30 to 40 years, Jamaica's average GDP growth has been within the range of 0.5 to 1.5%. The IMF really refers to that as anemic growth. But what all the forecasts combined are suggesting is a return to normality, which is within that 1% range, but with a slight tilt towards the upside, meaning that the still continued positive effects from the from recovery or the elimination of the restrictive movement, the restrictions in terms of movement on the economy, that we are actually, or we could see that pushing the GDP level a little bit above what would be the normal trend growth for our economy. All right, I want to zoom in on construction because of the fact that it's one of the areas where the financial institutions would have been overweight in terms of their portfolios. And we also believe that it's one of the areas that would be significantly impacted by the increase in interest rates or lending rates that we see now. So if you look at the last row and we look at construction, we will see where for the last 3 to 4, yes, the last 4 quarters, we have been seeing a contraction. Now note, construction would have been one of those sectors that the government of Jamaica tried to maintain its operations in terms of during the time of COVID and the restrictions in terms of movement, particularly because of the positive spin-off effects of this sector on the economy. Now, we are of the view that the high interest rates to developers ranging from 14% up is a significant challenge for many of them. The reduced appetite for exposure to apartments by some portfolio managers, combined with fund managers trying to diversify their real estate holdings into commercial real estate, and some of them preferring exposure to warehousing. That may have also slowed the growth of the sector. The increased risk weighting of loans in the construction sector by our monetary authorities, and a reduction of the risk weighting of loans to other sectors of the economy. That's also something that you would have to bear in mind. I remember that risk weighting is very important when you're calculating your capital asset ratio, because in the denominator, the risk weighted assets is something that, you know, tends to be very, very important, and everybody wants to be in line in terms of their adequacy ratios. Now, we do not believe, however, that the sector's performance is going to fall off a cliff. We believe that for the construction sector, we still have some sweet spots, that low to middle income housing segment by developers such as Gore, New Era, Chemtech. That part of the market remains lucrative with strong demand. Remember that the NHT also has their guaranteed land buyback program. They also have their land bank, and they also have a guaranteed buyback program where if as a developer, you approach a trust and you have negotiations or discussions with them, they will provide a guaranteed buyback in terms of the houses that you can develop. And once you bring them in within a particular price range, the NHT has a particular segment where it guarantees you those houses to buy them from you or from your development. Now, the other thing, or the other reason that I don't believe that the sector will fall off a cliff, based on an April 2016 IDB study, the title of the report was "The State of Social Housing in 6 Caribbean Countries." The draft National Housing Policy provides the latest assessment of housing needs for Jamaica as 20,000 per annum to meet the new demand and to reduce the housing deficit in Jamaica. Now, the thing is, at no time, based on the numbers that I've seen from the ESSJ, have we ever been able to produce 20,000 housing solutions within any 1 year. And if you look at the ESSJ, and I'll show you that overleaf, you will see where housing starts and housing completions was between 4,900 and 2,300 respectively between 2017 and 2021. So what this is suggesting is that there remains demand for housing within a particular segment, because we have never really been able to meet that excess demand for housing in Jamaica. Also, the other reason why we don't believe that the sector will quote unquote fall off a cliff is that you still have highway construction. You have 75 billion in GOJ capital expenditure. Remember that we're able to spend capex now without generating any kind of fiscal deficit based on how we have been operating over the last couple of years in terms of that tight fiscal deficit to, you know, marginal surplus kind of range. Remember that you also have GOJ expenditure on programs and projects, because remember that, you know, there's the Cornwall Regional Hospital expansion, there's expansion of other hospitals as well. So what the fiscal does is that the fiscal provides you with that increased impetus or that increased push from government, which we would have, you know, sort of struggled with over a number of years, but now we see where the government has the capacity to spend more, and that represents a significant injection into the domestic economy. And I believe that the construction sector is one of those sectors that might definitely benefit from government activity. All right, again, another sweet spot. The diagram here, I borrowed it from the ESSJ, and it really just shows what we spoke to before with the total housing starts and total housing completions, and the fact that we have never really been able to meet that 20,000 number that came from that IDB study. The other thing that we like about construction is that, remember that the diaspora is still one of the fastest growing segments of bank loan portfolios in terms of the demand for domestic housing. Some persons overseas, they are able to borrow loans from overseas banks, letting them know that they want to use it for Airbnb purposes in Jamaica. And remember that that segment of the market still remains relatively lucrative. The other sweet spot is taking a J dollar loan from a local financial institution while you are earning US dollar flows. Remember that we have a situation most years where there is a devaluation of the currency. So if I'm earning US dollars and I'm sending back consistently, for example, 1,000 USD to pay my mortgage, remember that as the years go by, the nominal value in J dollar terms of that 1,000 US dollars under normal circumstances tends to increase nominally. So the person earning on the asset side US dollars and then having the liability of the J dollar mortgage, that is definitely a sweet spot in terms of the capacity for you to pay down that mortgage very quickly. The other thing that I'd like to note is that the cost of housing in New York and Toronto versus Jamaica means that persons who are from the diaspora, it's difficult for them to afford housing in some of these areas. And if you compare that to where housing prices are, even in US dollar terms in Jamaica, you find that that diaspora interest is definitely something that is a positive in terms of keeping construction activity up. So I won't go into detail in terms of all of the other sectors, but just to note that this is one of the areas that I find of significant importance for us in the financial services sector. Now, the local interest rate outlook, as we said before, from the Bloomberg survey, that the possibility of US rates optimistically, looking to be cut maybe somewhere in Q1 or Q2 of 2024. JMMB researchers have the view that as US policy rates begin to decline, BOJ policy rates should follow suit, maybe with a 1 or 2 quarter lag, especially because locally our domestic inflation rate has really come into the higher band of where of where our local target rate is from the central bank. Remember that the Bank of Jamaica has a target rate of between 4 and 6%. Inflation is now at 6.1% year over year as at May 2023. So since March, the Bank of Jamaica has actually kept its policy rate fixed at 7%, citing a deceleration in inflation and lowered inflation expectations. In fact, instead of raising the policy rate in March, the BOJ actually increased the cash reserve requirement by 100 basis points in its attempt to continue to control inflation. So domestically, what we're looking for is when the Fed will begin to cut its rates. The good thing for us is that our local inflation is declining, so that's a positive domestically, but we still expect that interest rates will remain elevated, at least for the rest of the year. In terms of inflation, we spoke to it before. For the rest of the year, we expect that domestic inflation will come within the central bank's range. We expect about 5% by later down in the year as shipping costs begin to come down, or they have come down already. Remember China's zero COVID policy, they have now, for all intents and purposes, relaxed that. And the fact that we had a high CPI base and the numbers are slowly returning to normality. There is risk, however, to the upside from global price shocks, particularly energy prices. Adverse weather-related conditions could also push up rates, but generally we expect that inflation will come back into the central bank's target range. Now, the outlook for the local equities market, theoretically, if fixed income rates are high, then the equities market is not expected to do well. Further, remember that our local JSC, we don't tend to have very high dividend yields, most of them below 5%. I think Carreras and maybe one of the big commercial banks may be the highest in terms of its dividend yields. Really for us is really cap gains that does the trick in terms of upward price movements. But remember that a few of the entities are not, especially the financial sector entities, are not really showing great profitability at this time. Some of them actually have not paid dividends in a few quarters. So this is kind of creating a dampening effect for the market. And when you combine that with where fixed income rates are. Now, given that individuals, whether retail, and given that institutions can actually access rates anywhere between 10.75% and 15% on a 2-year tenure, then clearly, you know, most persons will look to take advantage of the fixed income offerings in terms of, you know, where to put their money. So for us, we're seeing where the local equities market will see some challenges. We have here a picture of the Jamaican dollar corporate yield curve, and this just shows you that most people are at the short end of the curve. So nobody wants to go out too far, you know, primarily because you expect that interest rates will come back down. So you want to issue relatively short-dated debt so that when rates begin to come back down, you can roll over the debt at lower rates. But what the bunching up at the short end shows you is that there are a number of organizations who would have been rushing to issue debt. Some of them, you know, it depends on the credit quality that will determine the rate. Whether or not you have things like a strong customer deposit base, etc. So that kind of thing will definitely impact where your rates come out. But the underlying thing is that where fixed income rates are relatively attractive, it means that you expect to see some amount of challenges for the equities market. Now, if it is, however, that the expectation is that by 2024, mid-2024, you may see a situation where US policy rates begin to decline, then the question is, can you as an investor time the local market, right, and pick up important stocks just before the rally? You know, our view is normally that you buy stocks with strong long-term value and you try to average in over time. We believe that that's the best approach. The thing is, however, that you will have to bear in mind that there may be a burn on your portfolio or, you know, a negative carry during the time that you hold the equities, but that's a discussion that you'll have to have with the higher authorities at your company and, you know, look at the opportunity cost of you taking the position. But in terms of you trying to, you know, time the market as to where you should come in, that may not work for you. And once our equity market starts to move, you may not have the time to pick up some of the assets at the nice lower rates. Note also that as rates begin to decline, I mean, EM bond prices begin to increase. We know that loan or mortgage rates, we spoke to that before. And, you know, demand tends to return slowly once you have a situation where rates begin to decline. Another thing that I wanted to highlight is the fact that the higher capitalized stocks on the JSE tend to be financial sector stocks. So once there's a challenge in terms of, you know, high bond yields and therefore low bond prices, and where interest rates are high and loan portfolios aren't growing as aggressively, then the expectation is that most of the financial services companies won't be doing that well in terms of profitability, and therefore, because they are so highly capitalized, they tend to drag down the JSE. Now, in terms of EM bond or the sovereign debt outlook, EM bonds, we expect them to operate in line with whatever happens in terms of Fed rate policy movement. We know of the relationship between higher Fed rate policy and the yield on most of our global bonds. Remember also that in Jamaica, we buy what we know. So consequently, GOJ globals represent a significant portion of our bond portfolio. Caribbean sovereigns and quasi-sovereigns and a few Latin American assets would make up the bulk of our portfolio. The other thing that I would want to highlight is that remember that GOJs are zero risk weighted in terms of financial sector company balance sheets. So the issue is when you do your CAR calculation in terms of your risk-weighted assets, remember that GOJs will still have that bit of demand because of the fact that, you know, regulation domestically really would have created a kind of captive market in terms of demand for GOJ assets. So the bond market is very important for us to keep an eye on because of, you know, what we expect to happen in terms of Fed rate policy movements. But remember that that's also another very important market to watch because of the fact that there is almost the creation of that captive market based on domestic regulations. Remember, many of the pension funds, they functionally really are restricted to holding GOJ. They have a 10% restriction in terms of US dollar assets. Remember also that the reason that GOJ is also very, very lucrative is the fact that it's one of those assets that you're able to repo or basically used to fund a lot of your purchases. There are no restrictions on the GOJs that you can hold in your portfolio, but there are restrictions in terms of other assets. So what this means really is that there's a captive market for GOJ bonds. So even though we are watching closely what the Fed is going to be doing, etc., remember also that there is almost always a overbought position in terms of GOJ globals because of these factors that I would have outlined before. And this will definitely, while we expect that the bond yields, you know, are going to go up, there is still that captive market. So it tends to keep GOJs from, you know, blowing out, similar to what may happen in terms of other EM bonds. What we have here is just our relative value, which really looks at whether or not, you know, a bond is overvalued or undervalued. And we'd like to highlight that most of the times GOJ globals are overvalued. That is, even though there are challenges for many other economies, and it's, you know, some of the more challenges that EM generally would face, most of the times because of that captive market, there is demand for GOJ globals. So most of the times GOJs are considered to be overvalued in terms of our sovereign curve. And this is the short end of the curve. What we show here is the long end. So on the long end as well, the GOJs tend to be overbought because of that captive demand. So yes, whatever happens in terms of Fed rate increases will definitely impact GOJ globals, but then we have to look at the market in terms of our domestic dynamics and understand the fact that there is still a captive audience for our local bonds. All right, that's the end of it for me. I hope I didn't go too much over time. There was a lot more that we could have looked at in terms of specific segments of the domestic economy, but you know, obviously with the time constraints and the fact that we wanted to facilitate as many questions as possible, we came to an end at this point. So moderator.
Thank you, Jermaine. You put us in rapt attention. I just want to give you a quick behind the scene peek. So while you're presenting, one person sent me a message and said he's in London. It's 1:15 a.m. I think he said he has on his pajamas, but he just can't afford to miss your presentation. That's such a quality. Another person sent me a note and said, can we give you an extra 10 to 15 minutes? Of course. So that does demonstrate the extent to which your presentation sell off. Now, what I just want to say to the participants before we move into questions is that we specifically scheduled this webinar right within a few hours after knowing that BOJ would make their decision today. And you know, the Fed would have had their meeting about 2 weeks ago. So therefore, what the participants will get is cutting edge advice. And you have certainly delivered on that, Jermaine. So I'm going to just give you a chance to catch a breath. We're going to launch a poll, and then we're going to take questions for about 10 minutes, and then we'll bring everything to an end. So catch a breath a little, Jermaine. We're going to launch a second and our final poll, and then we'll take questions for about 10 minutes. So Karen, take it away. I'm going to ask for maximum participation in this poll. Again, we're just trying to understand in terms of the, the profile of our participants. Anybody seen the poll? No? Karen, give me an indication if you have any technical difficulties. If not, we can take it towards the end. All right, what we will do while Karen calibrates in terms of the second and last poll, there's some questions in the chat. I just want to ask you a question just to get things going. Jermaine, just tell us what will our lives look like if we get that rating upgrade to BB-, which would pretty much put us within the on the doorstep of, say, a downrep, which is BB. So give us a sense of what you think our lives on prices, on so. Yeah.
All right. The improvement in terms of the credit rating will have significant implications in terms of the risk associated with GOG as a sovereign. So therefore, in terms of when the government is looking to issue debt, right, you will see a situation where over time, the rates that they're able to issue debt at would be significantly lower. So they'll be able to finance all expenditure decisions, all plans in terms of development at much lower rates. And that's primarily the most important thing. The other thing is, remember that with the debt to GDP ratio declining, it creates a lot of room for spending. We have to compare what we would have had in years gone by, let's say 2003, 2002, when I just came in the market. During that time, we really could not spend on our capital infrastructure, the roads, aggressively to get the hospitals where they need to be because of the fact that we're always running a fiscal deficit. So by the time we got to the last part of the fiscal year, oftentimes we would not be able to spend the capital budget because we would look to hold it back in order to keep the deficit in line. Now that we're at a point where we're running only marginal deficits to surpluses to balance budget, we now are able to actually spend the capital budget and to take care of some of the important things that exist in the Jamaican society. So for example, if you notice that the whole massive expansion in terms of the Cornwall Regional Hospital, spending in terms of the Spanish Town Hospital, there was an announcement that the government will be spending on parochial roads. All of these things that would represent infrastructure work that we really should have been doing for years now, we finally now have that ability. If you realize also with the massive increase that the public sector workers would have gotten, including our politicians, we are able to do that without there being a suggestion that the fiscal deficit will be blown out. And that is something that is significant for us. So from a capital markets perspective, it basically means that GOG debt will be raised at lower levels. And for the borrowing market, which is the private side of the market, they will also be able to raise financing at lower levels. So what GOG's improvement in terms of its risk profile does is that it also forces us to move away from the point where we had what we call the crowding out effect, where we would always have, persons running to buy GOG securities and just putting down their money. It means that you have to now look at capital markets as a means of making money from a financial institution perspective. It also means that a number of entities can look to the capital markets, can look to Jamaica Stock Exchange to come and raise financing to be able to now drive the economy a little bit more. I have seen sort of over the years a adjustment or a paradigm shift where in the early days, capital markets units really didn't exist because you had high GOG rates. You didn't have to do much. Now is a situation where because GOG rates are much lower, and if we do get the upgrade, rates will go down even more, right? What we're seeing now is a situation where capital markets, the structuring of debt, even CFA qualifications, in years gone by, you wouldn't really need it because you wouldn't have that sort of dynamism in terms of the need to structure debt and the need to be able to explain capital market structures to individuals. You didn't have a lot of that because you had good old GOG at the high rates. So as long as we continue to improve in terms of our fiscal numbers, we get the upgrade, it represents an ongoing importance of the financial sector as that key area for driving growth and development in domestic economy.
Okay, thank you for that. So as I'm gonna move to Monique's question, and I'm gonna annex it with just the commentary from the BOJ today. So BOJ typically talks about this neutral rate, this mythical neutral rate. And so Monique's question is, at what BOJ interest rate level is will there be a high likelihood of major economic negative impact or contraction?
Well, what the central bank has been doing, right, is that they have been doing, in my opinion, a balancing act. So what they have been looking on is that they have been looking on the recovery that we would have experienced. If you remember the graph that I showed, that showed you the tourism numbers and the massive recovery because of how far off tourism had fallen. So what the BOJ is doing is that they are balancing that recovery of tourism, the recovery in terms of transport, storage, and distribution, and in terms of the movement and the relaxation of the restrictive measures. They're balancing that with the need to keep inflation under control by increasing rates. So I believe that at 7%, where policy rates are now, it's almost at that point where you don't want to increase rates any higher because you run the risk of having serious contraction in the economy. Now, if you look at the outlook that we presented before, we are seeing a forecast from most of the agencies as well as the PIOJ for growth in the 1 to 3% region. So we're still expected to see growth for 2023 that we're in now. But I believe that if it is that we push the policy rates much higher, which is above the 7%, then we start to get into that gray area where you would see a significant contraction in terms of domestic activity. And remember, a contraction is occurring already, because I highlighted construction, and there are a few areas where the cost of credit is becoming an issue for a number of those entities. But overall, the economy still continues to grow. But if we push the policy rate, I believe, up to maybe 8%, 7.5% up to that level, I think that would be a relatively challenging period. And remember that institutions are raising capital at 15% now. And 15% cost of capital is relatively prohibitive. Because when you talk to, when we go out and we do the presentations, etc., and we discuss it, with the different individuals who are looking for financing from the banking side, they will tell you that it's very difficult for them to do anything much with rates or with lending rates where they are. In fact, on the construction side, a few of the contractors are saying to you that, listen, if we don't have block and steel in the ground already with approvals from NEPA, etc., then we are not going to do a project. So the only way that we do it is if block and steel is in the ground already.
Oh, Interesting. All right, I'm going to take one last question in the chat. I'll take one of Monique's last question. We don't want to oversteer. Welcome. And I'm going to choose the one with about the residential inventory, because you mentioned the nexus with fund managers having participated in that space. And so our question is the new housing residential inventory being built at the price points where there is actual demand? So this is what you see trends. And
right,
please don't spill any state secrets, just
well, look at it this way. What we had with a particular hotel, I won't say much, is that that hotel sort of gave us a view that we shouldn't push the prices of certain apartment type complexes beyond a particular level. So that particular hotel sort of gave us that kind of, you know, inflection point, because, you know, the market didn't accept prices beyond that level. Generally speaking, when we interact with the developers, they aren't seeing a pullback in terms of the apartments. They are saying that they still see demand. The problem is that with the cost of financing being where it is, they're not sure if they increase the price of the apartments to maintain their profit margins, if it is that the market will be receptive of that. And remember that you still are seeing some of the housing solutions coming in the more affordable range. So Gore has a development now, New Era has a development. If you look at in Portmore, there is the Bernard Lodge city that is being worked on now. So there are affordable housing segments being offered to the market. The challenge is that many of us want to live in Kingston. And once we want to live in Kingston, you know, apartment prices are going to be very high, and it's going to be a challenge for us. So I would say that based on the individuals that I've interacted with, they are in this sort of, you know, tepid sort of feel. They don't want to go too high. And as I said, you have smaller cost solutions. It's just whether or not most of us want to live outside of the, you know, golden triangle slash kind of region. So that's where we have to look at our demand.
okay. So I'm going to go back on my word and take one last question from Gladstone Winter. And the question he has is, you know, what is the outlook for residential housing, specifically in the $15 to $35 million range price point?
The outlook in terms of that segment of the market is for continued strong demand. As we had noted before in the presentation, right? The IDB study suggested that we really need 20,000 housing solutions per year in order to help to close the gap. Now, when you look at housing starts and housing completions in the ESSJ, we have never produced more than maybe about 5,000 or 6,000 in terms of housing completions in any one year. So clearly there is that pent-up demand. Remember that we spoke also about, you know, the demand from the diaspora, you know, persons being exposed to, you know, racism, and, you know, the fact that the cost of housing is so high in places like Toronto, in places like New York. You can't get anything anything within that sensible range. So a number of these persons overseas, they look back to Jamaica and they look to affordable housing. So I would say to him that the outlook for that affordable housing market in Jamaica, it remains very strong. Also, in terms of anecdotal evidence, so we would have done a few presentations to some of the guys in that middle income category. And what they'll tell you is that if they put out 100 houses today, by the end of the week, it is finished. So that demand for mid-income type housing remains very strong.
Okay, so hopefully Gladstone heard that, and I guess he can just deploy some more of his liquidity in that segment. You know, you talk about money burning in your pocket. So with that, Jermaine, Interest of time, we're going to just close this segment. We certainly want to thank you for not your presentation, but just the way in which you engage with the participant and demonstrate a mastery of, locally, regionally, and so on. So you're certainly at the top of your game. And so we want to thank you sincerely for this presentation and your insights, okay?
Yeah, thank you very much. Anytime.
Okay, welcome. So with that, I'm just going to ask Karen to make one attempt to launch the poll. Okay, it has been launched, and then we're going to bring the closing remarks and, release everyone to their other obligations. Okay, so we're going to ask for maximum participation. It allows us to plan for future webinars. We want to make sure that the value proposition is relevant to you. And, that's the basis for conducting these polls. Give everybody another minute. Thirty seconds more. Okay, Karen. I think we can close the poll there. Thanks a lot for your participation in the polls. And so without any further delay, I just want to close by thanking our esteemed presenters, Lauren from Stifel, who opened the batting, and then Jermaine, who brought the curtain down in fine style, for providing valuable insights, which we're confident will provide a roadmap for you as practitioners, market watchers over the next 12 months. We certainly want to thank our programs chair, Rochelle Grant, who had overall responsibility for executing this top-class webinar, as well as Karen Matthews. Karen is our dynamic and multi-talented administrator. And of course, we don't want to leave out our board of directors and other volunteers who work behind the scene in getting the word out, and so that we could have a good time. So all that's left for me to say is until next time, walk good. We thank your participants for remaining with us and being in rapt attention and making this webinar a success. So God bless, walk good.